Hello and welcome. My name is Jeff from Finally Learn. Today we're going to work on relevant costing, which is a managerial accounting topic. It's in decision making, it's short-term decisions. So relevant costing is the idea of relevant or marginal or differential. All those terms mean the same thing. Sometimes you'll hear it be called marginal costing or differential costing or whatever. Now here's the idea. The key on this is fixed costs are fixed and won't change unless we're told differently. So usually we can ignore fixed costs in these short-term decisions. Whether we decide to keep or not, or buy or sell, doesn't means that fixed cost does not change. Whatever it is, it's the same. Now, because this is managerial accounting, we're going to use the variable costing income statement, which is sales minus variable cost gives us contribution margin, minus fixed cost gives us profit. So we're going to look at that all the way through. We're going to look at three different types of problems. The first problem is going to be special order. What happens if we're making products and somebody comes along and says we want to buy a special order of so many items at a certain price? The next one is going to be a make or buy decision, which is sometimes called the outsourcing decision. And then the third one is, should we drop a segment? What's it going to cost? What will our profit be if we drop a segment? All right, let's get started with the first little problem. The first problem is a special order problem. So we need to know what the current production is. The current production is 800 units and there's a capacity of 1,000. So we could produce 200 more within our current capacity. Our sales price is $40. Our variable cost is $24, and our fixed cost per unit is $12. Somebody comes along and says, we would love a special order of $150 at $33 each. Now, we're selling at $40 each. So are we willing to sell 150 just with no marketing, no extra work except to make the product? We can sell 150 at $33 each. So we'll do it if we're making a profit. We won't do it if we're going to have a loss. So what is our current profit or loss? Let's just see if we can answer the questions here. Our current profit and loss, you can just do this as per unit. It is sales minus variable minus fixed. So our current profit or loss is going to be the 40 minus the 24 minus the 12, and that gives us $4 each. And then since we're making 800, we're going to take the $4 times the 800. So our total profit is $3,200. This is the $4 each times the 800. So $3,200 is our current profit. Now, what if the special order, we can look at that just by itself, the special order profit or loss. Now, sometimes people come along and say, well, let's think about what we have. We know that we sell for 40, that cost us 24, and we're going to make $16. And our fixed cost per unit is 12, so we're going to make $4 per unit. If we're thinking like this, then 24 plus 12, it costs us 36 to make, and we will not sell at 33, so we'll say no, we're going to lose money. And so this is not correct. Let me show you what you're thinking though, what people think. -3 times 150, so you say, well, I'm going to lose 450. I don't want to lose 450. So therefore, no, I will not accept it. So I would reject. Now, do you see the problem, how it's incorrect? Now, fixed cost is not always $12 per unit. It's always the total fixed cost. So let's go back and think about what we know. What is the special order? What does it take if we produce one more? Well, remember, variable cost is what the next one costs. Are we willing to sell one at 33 that cost us 24? Yes, we are. So really, we should be thinking 150 units times 33 minus 24, which is $9 each. So it's going to be $9 times 150. We're going to make $1,350 extra dollars. So should we accept or reject? We should accept, because we're going to make extra money. Now, this is where people, they don't understand. They think, wait a minute, why are you ignoring fixed costs? Remember, we can ignore fixed costs because it doesn't increase when we add more products. So let's think about our current level of sales. Let's just do it this way. Let's look at total. At 800 units, we know our selling price is $40. So 800 times 40. Our variable cost is 800 times 24. And our contribution margin is going to be 32 minus the 19,200. That's going to be 12,800. Now, what's our fixed cost? Our fixed cost is 800 times 12. Now, the problem gave it to us as $12 fixed cost per unit. And you're really tempted to say, well, that next one costs $12. It doesn't. The fixed cost is fixed, right? It's the total is going to be $9,600. So what's our profit? Our profit is 12,800 minus that 9,600, 3,200. We're correct here. This is this number right here. We're correct. Now, let's just look at just the special order. Just the special order. So this is the special order. That's 150. How much is that going to cost? We're going to sell it for not 40, but 33, right? It's going to cost us 24, and we're going to make $9. So let's start with that. So we'll say 150 times 33. We're going to make sales of $4,950. Our variable cost is going to be 150 times the $24, so 3,600, and then we'll subtract out 4,950 minus the 3,600. Our contribution margin is 1,350. Now, how much does fixed costs go up? Fixed cost goes up 0. If fixed cost goes up when we produce more, it's not a fixed cost. The fixed cost is 9,600 before the special order and after the special order. So we can ignore it because it's not going to change. So we're going to make a profit of 1,350. This is 0, and we're going to make $9 per unit. Now let's think about total. If this helps, let's think about for the 950. The 950, we have 32,000 plus 4,950. For the total variable cost, we have 19,200 plus the 3,600. We can subtract out 36 minus the 22, and we get 14,150. What is our total fixed cost? Our total fixed cost is 9,600 plus 0 more. It's 9,600. So our profit is going to be 4,550. 4,550 is our total profit. So here is a special order. This only works if we have capacity where we can produce more. We had 800 with a capacity of 1,000. We could produce that 150, and it would not cause our fixed cost to increase at all. So one of the challenges is you just need to figure out what is your sales and what is your variable cost. So what's the minimum price we would accept in this problem? Well, we're going to look here at the 24. The minimum price would be 24, basically, right? You would probably want more than 24, so maybe it's 25, but you would approach 24. See, at first you think it's got to be 24 and 12. You think you've got to make $36 to be profitable. You don't. Once you're already making 800, then an extra 1 or extra 150, you just need to sell for more than that 24. The next one costs you 24, and the next one you're selling at 33. So yes, you're making $9 each. All right, same type of problem. Let's just switch some numbers. Special order number 2. Let's say that we have 2,000 units in current production. Our capacity is 2,500 units. Our sales price is 50. Our variable cost per unit is 36. Our fixed cost per unit is 20. Now watch. We're not making money right now. 50 minus 36 minus 20, we're actually losing money. So let's figure this out. What is our current profit or loss? Well, we're making 50. We're selling for 50 minus the 36 minus the 20. We're losing $6 each, and then we're multiplying that times. So let me take -6 times 2,000. So what we have is we're losing our current profit or loss. We're losing $12,000. We're losing $12,000. So does this mean we would not accept the special order? No, we're happy to accept the special order if we make a little profit on this. So our 12,000, what is our special order profit or loss? Well, we're going to sell at 48 items that cost us 36. We're going to make $12 each. So we're going to say 12 times the 300. We're going to make a positive 3,600. So yes, we want to accept the special order because we're losing money, 12,000, but we'd rather recoup some of that and lose 3,600 less. All right, so let's run through the numbers real quickly. What if we had 2,000 items and we're selling for 50, something that cost us 36. We're making 14 contribution margin. Our fixed cost per unit is 20. We're going to lose $6. So our sales, 2,000 times the 50 is 100,000 in sales. 2,000 times the $36 is 72,000. We subtracted out our contribution margin is 28,000. What is our fixed cost? Fixed cost is 20,000 times $20. That's going to be 40,000. So we're going to lose the 28 minus the 40. That's 12,000. Okay, we knew that. So let's do the special order of 300. All right, on the special order, we have 300 units. And remember, we're going to sell at $48 each, something that costs us 36. We're going to make 12, and we know that the fixed cost will not increase. So we're going to make $12 per unit. So 300 times the 48, we're going to make 14,400 in dollars for revenue. $36 times 300, our variable cost is 10,800. We're going to subtract it out. Our contribution margin is 3,600. Our fixed cost goes up 0. So our profit is going to be 3,600 minus the 0, right? 3,600. So if we want to combine all this, the 2,300 means we're going to take the 100,000 plus the 14,400. So just by selling 300 more, we're going to reduce our profit or loss from 12,000 down. We're going to lose less money, which is good. So let me just copy it all. So instead of losing 12,000, we're going to gain 3,600 on that special order of 300. Our total loss will go down to 8,400. Still losing money, but we'd rather lose 8,400 rather than the 12,000. All right, one more with the special order, and you'll be in great shape on this. Current production is 3,000 with a capacity of 4,000 units. Our current info is our sales price is $99. Our variable cost is $55. Our fixed cost per unit is $37. Now, we don't need this information. That's not, we can calculate that certainly. Our fixed cost information is $37. Now, times 3,000 is going to give us the total fixed cost. We don't have to know the total fixed cost right now. The special order says, what about 1,000 units at $80 each? So what's our current profit or loss? Well, we're making $99 minus 55 minus 37. We're going to make $7 profit on each one times the 3,000. So we're going to say $7 times the 3,000. So we're making $21,000 as our current total profit. What's the special order profit or loss? Well, it's going to be, we're going to make $44 each, right? So, well, no, this one would be $44 each. We're going to sell for 80 minus 55. We're going to make $25 each, and we'll take that $25 times 1,000. So we're going to make $25,000 extra dollars. So yes, we're going to accept this special order. Now here's how we think about this. We're going to assume that total fixed cost does not change unless we're told otherwise. So that's the way it works on these special order problems. Now we have a couple more. Let's do one that relates to make or buy. We're going to have make or buy in 3 parts here. So let's say we currently produce 2,000 units of part number 55J. And we can turn around and buy this for $45 from somebody else, but it takes 33 variable costs per unit. It takes $30 fixed cost per unit for a total of $63. So what is the cost to make the part? The cost to make the part is easy. It is just that $63. The $63 is the cost to make. What is the cost to buy? The cost to buy, let's say if we purchase the part from somebody else, then we close down our production, but we cannot assume we get rid of our fixed costs. So here's how much it costs to buy. It cost us $45 plus it cost us $30 of fixed cost. We cannot assume fixed cost just goes away because we want it to go away. We have to be told that it's going to go away somehow. So we're saying the cost to make, the cost to buy. If we close down the production line to make the 2,000 parts, we're going to buy this 45 and still pay 30. So should we make this or should we buy it? Well, it's cheaper to make. It's cheaper, the $63 to make rather than buy. Now, this is short term. We just can't get rid of fixed costs. If we wish or hope, we have to have a plan, a reason why we think the fixed costs would go down. So what we want is, we want fixed costs that are avoidable. So the idea of avoidable fixed costs means, all right, this $30, let's assume 30% is avoidable. So let's do a little calculation. So for the fixed cost, we would say that 30, and we'll multiply that times 1 minus the 30%, which would be 70%, right? So we'll say, look, if we get rid of 30%, we're left with a 70%. So 70% times 30, then we're going to assume that our cost is going to be $21 each. So what is the cost to make our part? $63. What is the cost to buy the part? Well, it's going to be the 45 plus the 21. So we're going to say that the cost to buy is going to be $66 and the cost to make is $63. So what do? We still plan on making the product because it's still cheaper to make it rather than buy. We're making the assumption that only 30% of our fixed costs we can avoid if we decide not to make that part anymore. So let's change one more thing here. Let's assume that 60% of the fixed costs are avoidable. So to calculate fixed costs per unit, we take $30 times 1 minus the 60%. We're going to be left with the 40%. So 30 times 40, instead of being 21, it's going to be 12. So our fixed cost will be $12 per unit. So what's our cost to make? Our cost to make is still going to be the $63. What is the cost to buy? The cost to buy is still going to be that $45 now plus only $12. So 45 plus 12 is 57. So should we make this or should we buy it? It's cheaper to buy, even if we have to cover some of our fixed cost. Some of it is not avoidable. All right, the last little problem is dropping a division. So let's look at this dropping a division. We have 3 divisions of our company: Alpha, Bravo, and Charlie, and we have total. Well, let's look at Alpha and look at Bravo and Charlie. Alpha has sales of 100,000 and then profit of negative 20,000, has a loss. Bravo is 200,000 and making a profit of 10,000. Charlie has 500,000 and making a profit of 80,000. Combined, the company has 800,000 of sales and $70,000 of profit. So what if we think about, should we close the Alpha division, what would our profit be? If we close Alpha and get rid of this, then we'd only have Bravo and Charlie. What kind of profit would we have? Now, a lot of people, here's the decision error that you make. A lot of people think, oh, well, you have Bravo and Charlie, you have 10 and 80, 70,000 will grow to 90,000. So 80 and 10 are going to be 90,000. So yes, we would do it. We'd just get rid of the losing division. Well, let's think about this. What happens if we have Alpha has 0 revenue, 0 variable cost, 0 contribution margin? Can we get rid of fixed cost? Well, we can assume that we're going to get rid of fixed cost. So let's just model it this way. We have 0 contribution margin minus the fixed cost. So we're going to lose 70,000 on that division. You're saying, but wait, we're closing that division, but let's think about it. So you still have 200,000. You still have 120. You have 80,000 as your contribution margin, 70,000 as your fixed cost, and so you'll still have 10,000. For Charlie, you'd have 500,000, 350,000. This would be 150, and then 70,000. The problem is, let me add all this up. So we got 700,000 all the way down. Our profit is going to be not 90,000, not 70,000. Our profit is going to be 20,000. All right, that's surprising. That's why we have to do a problem like this, to show you how this works. Why did our total profit go from 70,000 down to 20,000? Well, let's look at what we had. Let's look at the Alpha division. Alpha was selling 100,000, the variable cost was 50. So if we close down Alpha, we lose the sales, we lose the variable cost, and we lose a positive contribution margin of 50. So we're giving up 50,000 of positive contribution margin, and we're saving how much in fixed cost? 0. We're saving 0 in fixed cost. Are you willing to give up 50,000 of contribution margin to save 0 fixed cost? No, you're not. You'll be 50,000 worse off. You'll be 50,000 worse off if you drop, because you're getting rid of that positive contribution margin. Now, here's a statement that you need to be aware of. You need to understand this in accounting. The allocation of fixed cost is arbitrary. That means, arbitrary means we could pick many different ways to allocate fixed costs. There doesn't have to be one way. Now, how did they allocate this? Looks like they allocated this completely evenly. So let's look at the ways to allocate it. You could allocate it evenly to all divisions. That is super simplistic. That's not really thinking. Why would you do that? Remember, let's look at what we have. Alpha has sales of 100,000. Bravo is twice as big with 200,000, and Charlie is 5 times bigger with 500,000. But this company decided to allocate evenly to all divisions. That's super simplistic. That's not helpful for Alpha. So you could do a couple other ways, and these are just 2 ways that we can show here in this problem. There could be more ways. You could allocate it based on the relative sales of the divisions. That's a better way of doing it. Or you could just say, look, I don't want to allocate it to a division. I'm just going to have the total, and we'll show you how this works. So let's see how they allocate it to the division. They basically said, okay, we have fixed cost of 200,000. We'll take the 210,000. We'll take 210,000 divided by 3. There's our 70,000. We'll take 210,000 divided by 3. We'll get 1/3, 1/3, 1/3. 210 divided by 3. So that's the problem that we had. They allocated evenly to the 3 divisions, and Alpha looks bad because of this, because only 1 out of 100,000 out of 800,000, 1/8 of the sales, and they get 1/3 of the fixed cost. That's a lot. And so yes, Alpha looks bad. Alpha, says, hey, you're losing money. We're going to get rid of the Alpha division, but you're getting rid of the fixed cost, the contribution margin of 50,000 that's positive. So let's look at the second way. You could allocate it based on relative sales. So let's think about what we have. If we take the 100,000 divided by 800,000, well, that's 12.5% of sales. If we take the 200,000 divided by that 800,000, that's 25% of total sales. 500,000 divided by 800,000 is more than 50%, 62.5% of sales. Another way to think about this is the percentage. You could do a percent, where we did the percent. You could do a fraction. 1/8, 100,000 out of 800,000. 200,000 out of 800,000 is 2/8. That would be 1/4 certainly. And then 5 out of 8, 500,000 out of 800,000 is our totals. So you could allocate. Let's allocate this based on relative sales. So the 210,000 times only 12.5%. Well, Alpha would get 26,250. If you took the 210,000 times the 25%, Bravo only has sales of 25% of the total 800,000, so they would only get allocated 52,500. Charlie has more than half, 62.5% of the sales, so that number times the 210, 62.5% times 210 means it's 131,250. Let's say you're Alpha, you're in charge of the Alpha division. You say, look, if we allocate based on relative sales, my division that only sells 100,000 makes 23,000, and your division that has 500,000 of sales is making 18,750. Alpha is making more in profit if you allocate it based on relative sales. Let's look at one more way, and we're finished with this type of problem. You could just say, look, why even allocate at all? Why do you have to allocate and get a per unit? Why can't you just stop at the contribution margin? And so you have 50,000, 80,000, 150, and you have 280,000 is your contribution margin, and you just say, hey, fixed cost is 210. It's for all of us. We're not going to allocate it to Alpha, Bravo, Charlie. It'll be 210,000, and our profit then will be 70,000. So you could allocate it evenly, which gives you kind of bad results for Alpha. You could allocate it based on relative sales, or you could allocate it not at all, right? You could just say, we're not going to allocate this at all. Now, let's think about something else. Let's look at contribution margin percentage. So let's take contribution margin divided by your sales. So what percent is that for Alpha? 50%. So for every dollar of sales, they get to keep 50% as contribution margin to pay off your fixed cost. Bravo is 80 out of 200, that's 40%. Charlie is 150 out of 500, that's 30%. If you were in charge of Alpha, you would say, look, we're the smallest division, but we're the most profitable per dollar. We're the most profitable per contribution margin percentage. So you should not close down Alpha. You should try to get Alpha sales to increase because you're making a contribution margin of 50%. Alpha is the most profitable in terms of contribution margin. All right, that's how you work problems when it talks about relevant costing or marginal costing. And thanks for watching.